Welcome to the BIP Ventures Extraordinary Pursuits podcast, a fascinating and inspiring journey into the world of venture capital and startups. Each episode offers masterclasses and entrepreneurial stories from some of the top minds in the innovation economy. Get ready to unlock new ideas and gain valuable advice for how to thrive as an innovator and an investor. Welcome to the Extraordinary Pursuits podcast from BIP Ventures. Today's short episode is a special edition focused on the upcoming annual State of Startups in the Southeast report. Mark Flickinger, general partner and COO, shares highlights from the 2024 edition. Mark has been at the forefront of shaping this report since its inception in 2017, so he offers a breadth of insight into the capital environment trends in the 2024 report. You'll hear how startup funding is beginning to find balance after the pendulum swings that defined the pandemic and post-pandemic years between 2020 and 2023. He shares perspectives on research into deal size and competition, the rising popularity of various alternative private market asset classes, and of course, the widespread impact of AI. Whether you are a founder, investor, or simply fascinated by the evolving startup ecosystem, this episode and the State of Startups report offer a nuanced and useful view of the startup environment in the region. You can check out the past year reports and sign up to get an early version of the 2024 report at bipventures.vc/State of Startups. Let's get going. So we're going to start out talking about your perspective on the sort of capital environment for the first half of 2024. In particular, just curious to get your perspective on how startups are using capital, now versus over the last couple of years.
Yeah, great question. The 2024, the kind of recap of where we stand from a private market perspective in 2024, I think is an extension of kind of what we saw at the tail end of 2023. So we saw a tremendous kind of slope down in terms of deals being done, dollars being deployed, size of those deals, et cetera. And then it really kind of felt like in 2023, we sort of leveled off, call it a trough, if you will. And I would say in large part, there's not a ton of metrics yet, but it feels like in this first half of 2024, we sort of digested most of that, the kind of broad brushstroke across the private markets and are starting to recover. And how do you see that? I don't think we'll necessarily see more deals being done in the first half of 2024. We may not necessarily see more dollars being deployed in 24 than we saw in the first half of 23 or second half of 23. But what we are starting to see is a little bit more competition for deals, right? So back to this kind of good companies get funded one way or another, we're starting to see sort of the competition come in where they're able to sort of move the revenue multiple up in terms of price, or like the price of the deal gets a little bit more competitive. So I do think that, it's getting healthier. People have sort of digested what's happened over the past couple of years. And once we kind of roll through all the valuation changes and necessary needs, I think we'll start to get back to an environment that feels like we're growing again and no longer sort of stagnant.
No, that's great. And how would you say that the Southeast is sort of trending in comparison to what we would call the big three, Silicon Valley, New York, Boston regions?
Yeah, we're looking at the funding trends in the Southeast compared to the other kind of big three, Silicon Valley, Boston, and New York. What we've seen in the past in our State of Startups report is sort of a more muted kind of variance in terms of both ups and downs of investing. I think we're continuing to see that, right? So if the Silicon Valley, to use the extreme example, went way, way up and then way, way, way down, we kind of went up and down. And so I think, because of those wild swings, we probably can recover a little bit faster. You'll start to see kind of movement in the Southeast. It's easier to detect than the kind of wild swings that you see in the bigger kind of innovation centers within the U.S.
Yeah.
The other thing is that in the Southeast, it's typically deal sizes are a little bit smaller in aggregate. So if you're relying on a lot of funding and money isn't free anymore in order to do your deals, that's going to be a little bit more repressed or slower to recover. with the cost of capital being what it is. Whereas in the Southeast, with these smaller deals that are kind of single digit millions of deals on average, you're able to kind of get back to doing those faster than you would in the innovation hubs.
Interesting. Okay. So there was a study that came out not too long ago, a couple of weeks ago, about there being an increase in the number of flat and down rounds. And I'm curious, given what you're talking about in terms of the trends being slightly muted in the Southeast, what you think is sort of causing that? Is it a natural adjustment? And what do we think that that means for the Southeast as sort of a capital environment?
Yeah, can go a lot of different places. That the chart or the report that you referenced is around the percentage of flat or down rounds being the greatest that it's been in the past 10 years. So that number is 30% of rounds that have been done, I think, in the first half of 2024 have been flat or down rounds to the previous round for the company. Mm-hmm. I think that that's a lot of digestion of people's valuation policies. So, it's common in practice to live on last round financing, LRF, that typically lasts, call it 18 to 24 months. We're kind of at the tail end of 18 to 24 months of where we were really at our peak, kind of end of 21, beginning of 2022. Mm-hmm. Personally, I think a lot of people were sort of sitting on their last round, perhaps a little bit longer than they should have. Mm-hmm. It kind of trying to get through this trough, as we talked about earlier, to get to the next funding where they could fund a deal where the company is growing. I think the reality is the market was so hot and unhealthy back then in terms of the prices people were willing to pay. You never were going to get back there. And now people are just sort of like taking their medicine and digesting. Most likely there are promising companies that warrant additional capital. They just don't warrant it at a price that's up from the last time they took capital. Mm-hmm. So I personally don't think that's a Southeast trend. I think that's an aggregate across the US trend, mm-hmm. most likely kind of in these innovation hubs that we've talked about with Silicon Valley, Boston, and New York. I think the Southeast has a very different approach to investing, right? It's smaller amounts of capital more frequently as these companies warrant getting through a different growth trajectory. The data supports that being healthier for both the investor and for the entrepreneur, but it's a very different style of investing. You're not going to just put $20 million on the balance sheet of a business that has $1 million of revenue at some high valuation and hope that it works out. Mm-hmm. You're sort of like helping these companies go through checkpoints and build and scale. So I don't think, that 30% number we started with, I don't think the preponderance of that is happening in kind of the quote unquote rest of the US, right? This secondary and tertiary innovation hubs, that's mostly driven by areas where there were a ton of deals being done, a lot of capital flowing back and forth. Prices got a little excessive, mm-hmm. and now we have to pay the piper, so to speak.
Yeah, kind of readjust and settle back down. Okay, awesome. So, from an investor standpoint, what kinds of trends are you seeing with respect to how venture is sort of behaving in the Southeast in terms of, is the money staying in the Southeast? Are we following those trends of slightly smaller but maybe more frequent investments being made?
Yeah, so dollars being deployed, I'll call it out of the Southeast, right? So investors based in the Southeast, what are the trends that we're seeing? Yeah, I think there's reason for optimism here as well. I mean, the macro trends that exist today are the same that everyone's kind of dealing with. I think from a Southeast perspective, I think investors, same thing. They sort of digested this world that we're in, and there's still good, promising companies that are being built that we're able to sort of deploy capital into. One thing that I think it is interesting is that other people have noticed the Southeast as well. So there is capital coming in from investors that are not based in the Southeast. I think that's a really good thing. Mm-hmm. And so your question about where are the dollars being deployed? I think Southeast investors are being forced. That's a good thing, but they're being forced to look elsewhere, right? They can't just invest in their backyard because it's a more competitive environment, right? So that helps entrepreneurs who are building in the Southeast. I think it makes investors better, right? A little bit of healthy competition makes you better, but you are seeing some dispersion of dollars being deployed kind of more broadly, not necessarily across the entire country, but more broadly because they have to. And that means that kind of companies that warrant additional capital will get it, whether they're based in the Southeast or Iowa or Indiana or wherever they may be.
That's very cool. It kind of connects the dots a little bit across the sort of funding ecosystem and the startup ecosystem. It's very cool. As an investor, I think that's also really kind of interesting because you have so many private companies building value, before they would go public, or maybe they don't ever go public. And so, having the ability to sort of widen the aperture and look at more interesting, high value, high potential companies outside of maybe our backyard, to use your phrase, is really interesting. What else are you seeing from the standpoint of, investors having options for ways to put capital into these promising companies?
Yeah, I mean, from an individual investor perspective, so getting out of the kind of general partner GPC and thinking about the LP where I'm an individual investor, I think first I would say that you really need access into the private markets. The statistics I think are quite stunning. We have less than 50% of the public companies that we had just 20, 25 years ago, right? So if you're only investing in the public markets, your options are 50% less than they used to be, really just at the turn of the century. And I think more stunning is of businesses that have $100 million of revenue, only 13% of those are public, right? So 87% of businesses that have $100 million of revenue, we only have a couple of those in our portfolio, are privately held, right? And so I think as an individual investor, first and foremost, I think you should look to try and have access into the private markets. The great news is there's like way more options and accessibility into the private markets now than there has been before. That comes in many different kind of looks and feels. One is private credit. Private credit is a huge tool right now. It's growing quite precipitously. It happens to be one of the top performing asset classes out there for an individual investor to have access to. That is being used in many ways to help fund these companies get across this chasm to get to the next place. So, you have to be thoughtful about where you're deploying your capital, but that's a great place for someone to have access into the private markets. There's a current pay component to it. From an individual LP perspective, it makes a lot of sense. The other thing is just new kind of structures of funds, where you're building funds that are evergreen in nature that provides a whole ton of value, pros and cons like any fund does. Business development companies are becoming very popular, more common in credit. Right now, we have an equity BDC product that's been very successful. That's kind of a one of a kind as it stands today. And so I think as an individual investor, you're able to get into the private markets with lower minimums than historically you've been able to get to, greater access than you've historically been able to get into. And then if you can find it with sort of great managers, it's a great way to balance out a portfolio, really truly have access into this innovation economy, and not do it at some place that sort of is a stretch or too much of a stretch in terms of your overall exposure from a portfolio perspective. Yeah,
I think that's really interesting for a few reasons. I think one that, if you think about, goal alignment and, the companies that you would be interested in and, what that will mean as we have all of these new assets and vehicle types showing up and more different types of investors getting involved over the next few years. It'll be interesting to see what that does to sort of reshape what the innovation economy even looks like. Not to mention the fact that founders are able to use those, funding vehicles differently, like you were talking about with private credit versus equity. I think it could be really interesting to see how that reshapes things over the next couple of years. Something to watch for.
Yeah, for sure.
Yeah. So as we are looking at the investment and funding data, what we're seeing is, you've kind of mentioned before, a bit of a resettling into sort of more pre-pandemic trends. People are, taking their medicine after being, maybe overvalued for a while. What is your perspective on what we might see through the course of 2024 and maybe even into the next year in terms of what this settling could look like?
Yeah, as you mentioned, there's sort of been this pre-pandemic, during pandemic, post-pandemic, and I think the investments have relatively kind of are in the process of settling back out again. Your specific question was kind of what are we seeing and what can we expect over the next kind of half of 2024 and into 2025? I expect sort of a rebound of the pendulum So, as we were sort of growing from call it 2010 up to 2020, there was sort of steady growth, particularly in the Southeast. More companies were being built, more capital is being built. You're funding these companies, you're starting to have exits. I think as an industry, the pendulum swung kind of really far one way, right? A lot of money being deployed in capitals. Money was essentially free, and at valuations that were very high. The correction has happened. I think that pendulum swing a little bit too far, right? I mean, people had to recover from, I don't know if I call them the sins of the past, but they had to recover from sort of what had happened in 19 through early 22. I think that pendulum will come back. It'll settle out, maybe not quite in the middle between those two, but I do think it'll kind of settle out where we'll get back on this trajectory of growth in terms of both dollars deployed, number of deals being done, size of deal will continue to go up. All the things you'd sort of expect in a rational market that's relatively balanced. So I think right now, if I were to look at the trend line from like 2010 through 2024, we're probably a little below where we expect it to be. And I think as we get to the second half of 24, we may not get all the way back up there by the second half of 24. But I think as we head into 2025, we'll get back to sort of valuations that are probably a little bit higher than they are now. More capital being deployed, that's kind of pushes valuations up, right? There's competition for getting into the best deals. But I think the velocity of capital being deployed will come back. And the reason that's really important is, we have this exit pileup. And as all the markets froze, we have all these companies that normally would be moved to the next rung on the ladder, whether they move from a growth equity firm to a private equity firm to a public market, whatever the case may be. That's sort of frozen. And that kind of gums up the works for everybody. And so I do think, we'll start to see a little bit of momentum, some kind of windows opening up where exits are starting to happen again. We'll get back to some kind of rational flow of capital between all the different parties as we head into 2025.
I think that's great. And I think we're seeing some general stability, from 23, and, there's a lot of talk of some of that thawing happening. So I think that's really smart. Any extenuating circumstances you think might throw some of that off? And by extenuating circumstances, I'm thinking about things like AI.
Yeah, I mean, extenuating circumstances, I actually think there are many, particularly this year, and this is not to be political, but anytime there's an election, particularly in the US, that changes dynamics. People kind of pause to see what happens depending on who wins. There's a bunch of turmoil around the world, right? So, not to say we'd be heading into a world war anytime soon, but that also gives people pause in terms of just risk in the overall economy. I think more specific to how you asked is that what kind of disruptive trends are going on. I think AI is a huge one. I mean, AI is here to stay. That's a good thing. I think the hype that has happened in terms of OpenAI and other kind of competitors to that space that are building the kind of building blocks or the foundation for order to AI impact everyone, I think that will settle out, right? Not everyone will be able to just start up a large language learning, module and suddenly they have billions of dollars of funding. I think that will kind of settle out in terms of that will be built, not to say it won't continue to get better. But the real key to success is how AI is applied into solving these problems that kind of sit in individual industries. We're starting to see that already, where the companies getting funding are taking this AI and they're applying it to make the solution to a problem more efficient.
Yeah.
And that's kind of a neat or a fun thing to watch, is how that's going to impact, the successful businesses that are able to get farther faster with, less capital, less kind of time to get there. And I think AI will have a huge impact on the success of individual companies within industries, as opposed to kind of thinking of AI as a big, broad investment thesis.
Yeah, no, that's really interesting. I think that there are some really good examples of that already kind of starting to show themselves. So knowing that we are in the thick of assessing the data from the second half of 23 and the first half of 24, looking at investment trends and the startup environment, we're seeing a lot of trends. Which, if any, is really kind of standing out to you as something that is going to, kind of pop this year?
Yeah, I mean, we're doing the work for State of Startups 2024 right now. There are a tremendous number of investment trends that we're looking at. The data is telling us a lot of interesting things. Given I only have a little bit of time, I'll only tease you with one. One of the things that's really interesting to me, we talked a lot about kind of being in this trough, or I call it a trough anyway, where, valuations have come down, dollars deployed has come down, number of deals have come down, and we think we've at least flattened out. We're not continuing to go down. Kind of 23 was flat. And what it's looking like is, first half of 24 is similar to 23 in terms of dollars deployed, roughly the same number of deals being deployed. But what's interesting is we're seeing median valuation go up, right? And so that's kind of an early indicator that we're getting through the trough and we're starting to rebound. We talked about this pendulum swinging one way and swinging too far the other way, and we think ultimately it will settle out, somewhere in the middle. But that valuation, kind of median valuation going up, I think is a good sign. Maybe not for the value investor that wants to invest cheap, but it's a good sign for the health of the economy overall, right? From an entrepreneur's perspective, that means people are coming off the sidelines. They're looking at promising companies. They're starting to compete to get their dollars deployed into those companies. That overall will push the value of the business up. And so really interesting insight. I think we've all been feeling it as we're doing our pipelines and looking at deal diligence. We've been feeling it anecdotally, but to actually see the data support it, I think is a great telling sign. And certainly more to come in State of Startups 2024.
Definitely. Thank you.
Thanks for listening to the BIP Ventures Extraordinary Pursuits podcast. Check the show notes on our blog for the resources we discussed. You can find Extraordinary Pursuits on your favorite audio platform. Be sure to subscribe to the BIP Ventures YouTube channel and connect with us on LinkedIn, X, and Instagram so you get all the stories, learnings, and ideas for ways to thrive in the innovation economy. And if you liked this episode, be generous. Share it.